Yeah, I mean, the panel was about equity volatility, past, present, and future. And I think the three main conclusion was that volatility, whilst it might be low, is not necessarily cheap. It's part of an exercise of portfolio diversification, particularly for multi-asset investors. I was quite surprised in terms of takeaway about the amount of systematic vol selling. So vol seems to be more used as a source of income and carry, as opposed to a systematic hedging instrument. And I think the third and final point was, at the end of the day, there's no one solution that is more interesting than the other. It's all about portfolio construction and mixing up different strategies and bringing market timing into the mix. So every fund is different, styles are different, and volatility is still an important diversifier for investing. Well, this is a quite interesting question, because when equity and bonds are moving together, you're losing diversification. So everything is behaving like equities, for example. So the obvious hedge would be to buy equity puts or equity volatility or equity variance swap, for example. The problem is that this sort of dislocation don't occur every time. So it's about making sure you're not wasting or burning premium by hedging all the time. The other alternative is contingent options. So you can buy equity puts contingent on rates higher, for example. It typically takes advantage of correlation and can cheapen that price compared to just buying volatility outright. Well, the benefit is that this is unemotional, so you are systematically harvesting income and carry. And there was one panelist who mentioned that even through 2008, had you been systematic in selling volatility, you would effectively have decent return through time, because as volatility spikes, you are able to sell it at a high level. The downside to systematic vol selling is obviously the drawdowns and the sizing. So this is why the design is important, and most systematic vol selling tends to be on the short term, because the maturity being short allows you to exit very quickly and roll into higher vol or higher premium when vol spikes. Today, one of the things we're seeing is dispersion strategies. So this has really boomed in terms of notional, not just with hedge fund, but also with institutional manager. So asset manager, pension fund, family office. And the strategy is simply selling index volatility to buy single stock volatility on bespoke basket. So it has the benefit of capturing sector rotation, but also capturing idiosyncratic risk. And this is a strategy that we find quite compelling for investor as a source of stable carry. Well, it seems to be the case, because there's a demand for investor or skillful investors who are able to harness short vol strategy in a stable and good Sharpe ratio manner. So one would have expected it to be crowded given the level of yield, but in fact, a lot of investors are still looking into strategies such as these. So I think there's some year for a short vol strategy and vol risk premium harvesting. Well, I mean, this is one of the questions that was addressed to the panelists, but it seems like the behavioral nature of hedging is something that is very profound in markets. So it will take a lot of time for it to disappear. So it seems like the need to systematic hedge long equity portfolios, for example, is going to be still pretty powerful and should provide enough demand or supply for this sort of strategies. Well, I think this is a great conference, because you get to see a network with a lot of investors from the whole gamut in terms of expertise, and this is also a conference where you can listen to new ideas, new development in the field of volatility. So I'm definitely very happy with the way it's been organized so far, and we'll still look forward to attending the next one next year.